Okay, today we're going to be talking about the stock market. Usually, probably one of the best pastimes for most people, other than talking about sports. And the stock market has been a bit schizophrenic lately. We've seen some ups and downs. We've seen a bear market. We see some pretty ugly numbers in the last month, which has people concerned. We have the worst Christmas Eve on record for the stock market. Of course, then yesterday it goes up 1,000 points. This morning it's all over the place on the downside. We have a 20% bear market from its top earlier in the year. September, October, I believe, is when that took place. We're worried about things like trade deficits and trade wars and possibly a recession and higher interest rates. So there's so much going on, and people are really very comfortable with the stock market when it's going up. Everybody's a hero when the market's gaining. And it's easy to make money in the market because everything's going up. It's also easy to stay consistent with your investing. So if you're investing through your 401k or through a retirement plan, if you get a little extra money coming in, of course, you're going to be very happy about putting the money in the market because it looks good. In fact, on Christmas Eve, when the market was down quite heavily for a half a day, I had put some money to work. I actually put $50,000 into an index fund, and I bought some shares in Altria. Now, some people would say, "Wow, it's really great," because then the next day the market's up 1,000 points. I made a quick $2,500, but that's not what I was doing. And in fact, that's what we're going to discuss. We're going to discuss things that will not involve market timing, because market timing doesn't work. Very few people can do it, and nobody's done it consistently for a long period of time successfully. There are people like Peter Lynch and Warren Buffett who've done very well investing in good quality companies, buying them at a good price and holding them for a long time. But keep in mind, even legends in the industry like Warren Buffett will buy companies and sometimes sell them when they realize they made a mistake. It's part of the process. In fact, though, probably one of the mistakes nobody wants to talk about is Warren Buffett once bought some stock in H&R Block and sold pretty quickly. If Warren would have given me a call, I would have let him know about my industry. So what we're going to do today, we're going to start talking about all these different things here. And by the way, some people are starting to log in. Excuse me. We're going to be, there's a place for leaving comments. So if you have some things in your personal life, some things you're doing, or if you're looking at making an investment, I can certainly give you some insight into it. I think that I have something to add to the huge heap of information on the stock market and in investing and that kind of stuff, just because I've been doing it for so long and I've been reasonably successful, certainly above average, above par for what most people would do. I'm going to start with a few little stories, though. One is current and one is something from my past a little bit when I was actually a securities dealer. So I actually was a stockbroker for many years in the 1990s. So I also understand a little bit of what goes on inside the industry, though it has changed quite a bit in 20, 25 years. The first one is that everybody, when the market started coming down here in December, we saw a lot of bravado in the market. On Facebook, I would notice people were like, "Hey, are you in the market yet? Are you investing more?" And everybody was pretty good about it, and they're very smug. And slowly but surely, you would start seeing some people with some comments that were a little more stressed. So one person was like, "I bought XYZ stock or Apple stock or something they had bought, and it was down, and they're like, they can't take the pain anymore." We're going to talk about that, by the way. In a little bit, we're going to talk about why you buy a company, because you're not buying a stock, you're buying a fractional share of that company. And when you look at it the way I look at things, you're going to realize that the market doesn't change that much, really. The day-to-day price differences that we horse around with are not going to be that significant. Now, the second thing I want to come up with here is that and this is something that this drove me crazy, because when the market's up, it's so easy to invest, and people actually get foolish when they invest then. So one person was on Facebook in one of the groups, personal finance groups, and the person had said, "I don't know what I can do. I put $60,000 into the index fund back in June, and it was for the down payment on my house. And now, of course, the market's down 20 or 25% from where they put it in. What do I do?" is their question. And most people are saying you don't sell. Well, I would argue with that also true. You shouldn't sell. But here's the thing. If you put money into the market and it has less than a 5-year time frame, then you have effectively said, if that is a down payment for a house, that you're not going to buy your house until at least 5 years or more into the future. That's just the way it is. I mean, if you're buying a broad-based index fund, there's no guarantee it's going to be up today or tomorrow. I'm going to tell you two stories. The first one is this comes from my days when I was selling securities, and it puts in perspective buying and selling in crises. So right now we're worried about things like the trade war in China. Maybe China's economy might go bad. Maybe higher interest rates will do some harm. We're worried about politics. We're worried about all these different things going on that could be detrimental to our investments. So the story that I heard many years ago is about the Cuban Missile Crisis. Here it is, 1962. President Kennedy has just blockaded the Soviet Union from Cuba. There are nuclear missiles and sites being put into Cuba, not too far from U.S. shores. President Kennedy comes on TV and says, you know what, Americans, we've picked out 50 cities in the Soviet Union that if they run this blockade, we're going to annihilate them. Of course, it means mutually assured destruction, if you will. We're both going to be dead. The world as we know it would come to an end. So in New York, there's a story about an old stockbroker that was working, and a younger stockbroker, kind of like an apprentice or an intern of some sort, working with this older broker. And the young broker's like, this is a crisis, sell, sell, sell. And the old stockbroker says, no, buy. And the young stockbroker goes, why? What are you talking about? If the missiles fly, everything will go down in price, the world will be destroyed. And the old stockbroker gave us some wisdom. He said, if the missiles fly, or if the missiles don't fly, then everything's going to be the same and everything's on sale. You can buy it right now. It's going to go up in price because nothing has changed. And if the missiles fly, the trades won't clear. Okay, so it's kind of a funny anecdote, but here's a more important lesson. So let me do this. A book that I recommend, I'll put a link to this a little bit later. It's The Simple Path to Wealth by Jim Collins, which is a good friend of mine that is in the personal finance community. Arguably one of the best books out there. I highly encourage it. I've added a lot of links, by the way, to my blog. I'll add this when I'm done, so you can get a link over on Amazon to pick that up. The reason why, and I'm going to hide this, should have done that right away. So what we're going to do is, make sure I turn that off in a second. Okay, so, excuse me. So let's see where Nick Murray's story. Okay, when I was in the 1990s, when I was in securities, there's a guy named Nick Murray, which came in to talk to us. And what he did is he had a long history of working with securities prior to that time. So he cut his teeth back in the 60s and early 70s, which was a very, very difficult time to be selling mutual funds. Mutual funds had 7, 8, 9% commissions on them. There wasn't no back end loaded fees and all that stuff. It was a pretty straightforward. You pay 7, 8, 9% for a commission. And the market was doing pretty badly from 68 to the early 70s. And then the market really took her bad in 73, 74 with the first oil embargo. So people would come in and he would sit down and talk with people about investing into mutual funds. There were no index funds then, so he would talk about things like growth and income funds. So people would come in and they'd always be worried, why should they buy now? Because the market might go down next week. It might go down 10%. I mean, even now the market's down about 20%. It's getting beat up today a little bit. In fact, I have another screen here, which I will share a little bit later with you guys, that we can look at this here. I can actually share this with you guys. We can go and and you can look at what we have here. It's like, oh my God, the world's coming to an end yet again. It's just another incident of the world coming to an end. But what Nick Murray said, and this is the important part about investing, is when a client would sit down with him, he would say, Mr. and Mrs. Client, I don't know which direction the stock market will move next at 10%. I don't know if it's up or down. In fact, the next 20% move in the stock market, I don't know if it's up or down. In fact, the next 50% move in the stock market, up or down, I don't know which direction will be. 50% move in the market. I don't know the next 80% move, which direction, up or down. I don't know the next 90% move, up or down. But I guarantee you this, the next 100% move in the stock market is up, not down. And the reason I know that is because it's always doubled. It's always kept on going up, has downers, down days and down periods, but it always keeps on going up then. And if it does go to zero and never comes back, there is no civilization. There's no reason to be here. We're gone. Okay. So it's over. So even cash is no good. So the risk, by the way, is to be out of the market, not in the market, because the next 100% move, the next 200% move, the next 300, 400, 500% move is going to be up, not down. And in 2008, when the world was coming to an end, and then it bottomed out, I think in 2009, people were selling at that level. Now it's up 400% from there. Now we're getting a pullback, and once again, the world is coming to an end. I want to show you something. Jim Collins has this, by the way, on his, let me see if I can get this here for you guys. This is something on Facebook here that he has, and this is a little chart that he's been putting around. And this is a history of the Dow Jones from 1900 to 2016. It doesn't include the most current stuff. Hopefully you can see my little pointer here. And it's kind of a joke because every time there's a market top, it says, yep, this is the top. This is it. It's all over top. And then every time it hits a bottom, it says it's over, and then, told you so. And then it keeps going back up again. This is a logarithmic chart on top of it. So you see from here to here, this is 125 in the Dow to 500. If you didn't do this logarithmic scale and you switched it down so that it was equilateral all the way through, the problem you would have is that everything except for the last 10 or 20 years will look like a flat line, because it would be like you couldn't see the gains. They'd be so small compared to today's gains. So the risk, again, is being out of the market. I mean, you look over here, here's 2008, it's terrible. This right here, this is the Great Depression, in 1929 to 1932. That was a rough one. And even that was not the end. Investing along the way would have been still the way to go. And we're going to touch on this a little bit, but just looking back in history, what dividend yields are, we're going to be touching on those in a little bit as well, too. So what we need to make sure as we start this discussion, we have to make sure, I got to make sure that I don't have, if somebody would like to leave a comment or something too, I want to make sure it's working on my screen so I'm seeing it. And if somebody just give me a thumbs up, if you would, that you're also getting good sound, because when I have this program, it doesn't always tell me if that's the case. And if I don't see any comments coming through, then I don't know if it's working, and I'm not sure if that's coming through. I'm not seeing anything yet. Well, as long as there's people here, I'm going to keep on going with this. I have kind of an itinerary here. I'll share this a little bit with you guys too. Some things we're going to talk about. So I talked about, people with a home or the home down payment in the market, which they shouldn't be doing. Excellent, good. And Jeff and Rob and Jenny and Christopher. Okay, excellent. Thanks, guys. This is the second point right here on my screen. Excellent, good. The sound's coming through good. So what I want to go into now is that this is the fearful time. This is the hard time. People are starting to get a little more dicey in their attitudes toward the market. So they're saying, well, when the market was up and it was down 5 or 10%, everybody's brave. They can add a little more money, buy the dip. I get it, and we're good with that. It takes a few more. It takes a stronger stomach, shall we say, when the market's down 20% and you're dropping 500-600 points every other day. You have a 1,000-point up day yesterday, biggest up day in point terms at least ever for the Dow Jones. But now today we're down. We're giving half of that back. I can give you my prognostication of where I think the market is going, but it's totally irrelevant. I'll tell you, I think the market has more downside, to be quite honest. Of course, I always think that. And I also think it's going to go back up and do very well. The reason why I think the market has potentially more downside is because usually these pullbacks don't end this way. They tend to keep on going. There's kind of a process to this thing. But I certainly wouldn't trade around it. I have money to the side that I have for working capital, and I keep money for other investments. I don't just invest in the market. I buy businesses. I buy other things as well. So that puts me in an enviable position that when I find something that's a good deal, I can pick it up pretty reasonable. There's cash available. Well, the market's going on sale. I'm going to be putting more of that money to work in that exact market. So the real money is made in bear markets, modest gains from bull markets. What does that mean? Well, when the stock market is up, it's by default, valuations are going to be higher. Their things are not at as much of a discount as they are when they are right now. We're going to talk a little bit about Apple stock, and I'm going to talk a little bit about Philip Morris as well, too. Excuse me, Altria. Old habits die hard with that investment. I've had that for a long time. Right now, there are opportunities to buy reasonably cheap compared to what it was. The market's about where it was a year and a half, 14, 15, 16 months ago, which means if you thought it was a great deal back then, you ought to be having a screaming buying opportunity right now. In the stock market, it's the only place where they don't buy things on sale. At least they don't want to. If stocks go on sale 50% off, you go to the store and take a special trip. You waste half a day just to get there and buy yourself extra pairs of socks 50% off. And the stock market goes 50% off, and you're buying some real good assets that generate an income that keep more than your toes warm. It's just it's crazy. People don't want to. They don't want to buy at that level for some reason. It's like nobody goes out there and says, "Oh my God, it's at the end of Christmas season here. Shirts and socks and shoes are on sale, half price off. Oh my God, they must be no good, because 3 days ago they were double the price, but today they're half the price, so they must be no good." So what's interesting with that is but they will do that for Apple. Here's a company that's trading at about 12 times earnings. If you take out the cash, they're trading at about 8 times earnings on their enterprise value. The profits on Apple are enough to buy back around 8% of the stock every year. This morning, somebody's on CNBC saying Apple has a 25% downside. Well, I guess anything's possible. And because of slowdowns in iPhone sales and all kinds of other crazy stuff, which is probably true. But even if their earnings don't grow, they just remain steady. They can buy back the company in 6, 7, 8 years. And if it goes down another 25%, as this individual on CNBC says, well, in 3 to 4 years, they could literally take the company private. It's an insanity. It's an insanity move as far as I'm concerned. There's nothing there that would indicate any of this. The economy might be slowing in some parts. Housing in some parts are getting a little slower. But the fact is, I'm not trying to buy. So I want to buy something that has a margin of safety, the Warren Buffett philosophy there, but I also want to buy something that has good value. I'm looking for a future income stream is what I'm looking for. I'm not buying a stock. I'm buying a fractional share of a company. It's like buying, if you came over to my tax office and said, "Geez, Keith, I'd like to buy a part of your company." You're buying a pro rata fractional share of that. And when there's profits, there'll be dividends kicked out. So this next one here, I talked about this too. All the worries are about politics, trade wars, higher interest rates. That is a little bit of an issue, but here, I'll give you my crystal ball because everybody wants that. The market interest rates, I don't think are going much higher, especially on the Federal Reserve. In fact, I would, if I were a betting man, which I'm not, I would bet that the interest rates will be a little bit lower at the Federal Reserve, at the Fed funds rate, at the end of 2019 than they are right now. I think that I just don't see the inflation, and I see a little bit of weakness in the economy. This is what I really want to talk about, and we're going to spend quite a bit of time, I think, on what you are getting when you buy a stock or a so. And by the way, if you're buying a stock, you're buying a pro rata share of a business. If you're buying an index fund, you're buying a pro rata share of every business in that index. You are an owner of that company. So you have to then decide what is that value? What makes Apple stock worth $150 a share? I mean, why would you pay for that? What are you buying? Well, I hope it goes up. Well, good luck with that. That's not a very good reason. That's gambling. Then you may as well just go to the roulette wheel over at the casino and put it all on black and see what happens. And good luck to you. The thing is, you own a part of a company. I try to make sure that when I talk to people, I don't talk about I'm buying a stock. I'm buying a part of a company. I bought more ownership in Altria. I bought more ownership in Apple. I bought a little bit of ownership in J&J. I bought a little bit of ownership in Microsoft. I bought a little bit of ownership. I put $50,000 on Christmas Eve. I put, for my money market, I moved it into the S&P 500 index fund at Vanguard. And that $50,000, yes, went up in value, but it doesn't mean anything because I'm not going to be day trading it. Oh, I made a win, because once I start playing that game, it's a fool's errand, right? You're gonna lose, and you're gonna lose a lot more quickly. What did I buy Christmas Eve? A 2.23% dividend yield. That's what I bought, and the future earnings and the increases on that. About 2.3 to 2.4% is what the money market earns. It's kind of a no-brainer if I'm a long-term investor. So this is what we're going to do here. The next one here is determining what is value. So you're going to buy yourself some stock. You're going to buy an index fund. And it doesn't matter if it's an index fund or it's an individual stock, okay, individual company shares. And the reason why is because you're still buying a fractional ownership of it. You're just buying with an index fund. You're buying all of them, or a big pool of them. So if it's a total market, you're getting virtually every company in the stock market. And if it's a world or an international fund, you're getting some other markets as well. An index feature, if you're doing the S&P 500, then you're getting a big, you're getting basically 500 companies that you own a pro rata share of. When you're buying a stock, so you buy Apple. So let's go over here, and I'm going to play around a little bit with some of this for you guys. Let's see if I can get this in here for you. And let's go to the stock market again and kind of refresh this so we can kind of see what they're doing. And we're gonna ask some serious questions. So as you can see right here, market's up 1,000 points, then it's down 300, and people are just freaking out. What they're not looking at, as far as I'm concerned, is people are crying at the market being down, or that they're acting like this is a big deal. But when you start going out 5 years, what we're looking at here is we're going back to basically, what about July, summertime of 2017, a year and a half ago. Man, if you've been investing for more than a year and a half, you still made a profit, and probably a pretty nice one, I might add. Plus, you got a dividend yield. Dividends have gone up over this time frame. Dividends go up, and by the way, your dividends that are reinvested are now going to earn more money than the other dividends did, because you're buying at a lower price in new shares. It's a good deal. So let me see if I want to make sure I get everything here. Excellent. So we're looking at the stock market, and here's what people are going to do. I'll do my prognostication. I'm going to tell you then why it doesn't matter. So if I were looking at this, I'd say, well, the market went up here, and if you go out to 10 years, it gets a little bit longer. And this right here that you see right here, this is about the halfway point in the stock market rally from the 2009 lows till up here into 2018. So some people say, well, this is the midpoint. So here's the Dow Jones right now. And we're kind of at a support level if you look at this little doodad over here. And then if you're a chart reader, you say, well, the market could go down to what about 18,000 in the Dow, or at least 20,000 in the Dow. That's kind of support. That'll be a 30-40% correction. My attitude is yes, it could happen, but it doesn't matter. If I'm buying good companies at good prices, I don't care about the stock price. I care about the income stream, because I'm not betting on the stock going up, because that's gambling. Then I go to the casino, I get much faster results, and I can keep on betting and betting until I go broke, just like you will in the stock market if you start day trading and playing around. So what I'm really doing here is I'm looking to buy this discounted future value of earnings. So think of it this way. You can take profits and you can say price earnings. Price divided by earnings gives you a price earnings ratio. But there's also an earnings yield. You flip that around, earnings divided by the price. That is basically what the dividend yield would be if they took 100% of the profits and distributed it. Now, that gets us to the next point here as well, too, because we'll kind of commingle some of these things here together. When you buy an index fund, when you buy an individual stock, you're buying this, you're making a call on the discounted future value of earnings. Okay, so what's the interest, what's the risk-free rate of return? Basically, a 10-year treasury bond, considered a risk-free investment. So okay, you have a risk-free investment, it's going to earn you 2.5%, 3%. Okay, so that's what I'm going to make, and you're going to discount into the future. Warren Buffett likes to say, with interest rates so low, I mean, the stock market could be trading at 100 times earnings and it would still be something that wouldn't be overpriced, especially when interest rates are at zero. We're not at zero right now. We're something above that. But in perspective, we have to understand the market is not that bad. In fact, I'm going to get this little guy out of here so you can see me there. There's two ways actually a company can get money from their profits, from their checkbook to you, the owner. There's a third way that they can use the profits to increase your future earnings. So you got dividends, which are cash right in your pocket. You got share buybacks, which means you own more of the company. So if a company has 100 shares, okay, you have a company that has 100 shares outstanding and you own 1 share. And the company buys back 10% of their shares, or let's make it even easier. They buy back half their shares, 50 of their shares. They have a buyback program. And they keep on buying and buying, and after a number of years, they've bought back half of their shares. Okay. You still only own 1 share, but you went from 1% ownership to 2% ownership. You now own more of the company. So share buybacks really do benefit you. And that also means that when they raise dividends, it doesn't cost the company as much money from their cash flow, because when they pay out the dividend, it goes to fewer shareholders. Therefore, the dividend can go up faster than the profits. It can go up faster than inflation and economic growth. And this is good for you because your pro rata share of the company continues to grow. So share buybacks are kind of nice. Dividends and long-term capital gains tend to be taxed a little better rates. The dividends you don't have a choice with, though, unless it's in a retirement account. So when dividends come in, they're going to be taxable immediately. The third way here is this reinvested profits. Now, profits, when they get reinvested, and if the company does it right, it works very well. Let me go to my next point here too. I think it'd be a good spot to even say this here is when you buy the S&P 500 index fund and you say, I want to, and you don't buy it for the price, you buy it for the income stream and the future income stream. When the stock market goes down, nothing's really changed for you. You bought it for the right reason. You want a pro rata share of ownership in that company or in those companies in the index. You are an owner. So if you bought this with that attitude, dividends don't change that much. They tend to go up 5 to 7% a year. Sometimes they do go down. Sometimes they go up more. And in fact, we can bring out a little chart here to show this. I have a couple of things here that so you can take a look at the dividend yield. Now, the dividend yield may change a lot over time, but the dividends themselves kept on going up. Not every year straight up. Some of these jigs and jags in this market right here, or in these numbers, is because stock prices either went up or down. So people buying at that day, that's their dividend yield. If you bought back here in 1980, okay, so I started buying when I turned 18 in 1982. I bought some stock. When I bought some Philip Morris back then, which is Altria and Philip Morris International now. There's some other spinoffs which I got rid of. But my basis in those original shares is in the single digits. My dividend yield is 100% of those original shares today. That is the most powerful thing that I can think of in the market, is that over time, and even if you're in the S&P 500 index, this is the whole S&P 500 yield, excuse me, so over time. So we have seen the dividend yield come down, of course, but then there's other things in here too. The earnings yield, that's where we flip this upside down. If the S&P 500 paid 100% of their profits out in dividends, we'd have about a 5.38% dividend yield right now. Why is that important? Because the risk-free rate of return is 2 and change, 2.5. And I don't think those rates are going to go much higher. I think earnings are still going up. Earnings went up exponentially, I guess, or extraordinarily in 2018, by and large, because of the tax cuts. Take that out, strip that out. We had a pretty good rate of return, but it's not going to be as good maybe going forward. But over the long haul, over 5-10-year periods of time, this is going to go up. Because if you don't believe that, then you just have to look at this chart right here, and it becomes clear very quickly that every time we call a top, it's not a top. The best news, and by the way, Stephen, he says, from Toronto. My Canadian friends, by the way, the rules still work in Canada. These are universal laws. You can go to any planet, anywhere in the galaxy or the universe, and these laws are immutable. They will work. This is what it is. Enjoy reading my blog. I love it when people read my blog. I do these videos because that's what people respond to and like, and some people respond better to that. But my preferred form of communication is writing, because I can spend more time thinking through things and coming up with ideas. But let's go back into this here. The market, the difference is, and I didn't pull up all of these, but CNBC had a bunch of things. I read CNBC pretty much every day. And they had a chart saying how long the bear markets last. And they had, it's about 5 years is about the longest before you make a new high. And then there's been a few that, quite a few, 6 months, sometimes a year, and they can be done. But I guess the average was like a year and a half or 2 years, something like that. But the thing is, if you were not scared about buying a few months ago, okay, you're looking at a couple of years probably on average before you make new highs. So you'll get a dividend yield in between, and you'll have a profit in your stocks after that, because as dividends go up, so does the price, because people are going to pay more for that income stream that continues to increase. But what happens is, for example, so Monday, during the shortened day for the Christmas Eve holiday, I went and put $50,000 into an index fund. So why did I do that? And what does it mean? Well, first of all, even if the market keeps going down, if it takes 2 years, takes 5 years, takes 10 years, whatever it takes to get back to a brand new high, I'm going to have made money long before that, because I bought it 20% off. Okay, it's 20% off the high. It's an S&P 500 index fund over at Vanguard. I'm going to be very happy with my life. I've got a 2.23% dividend yield locked in, even though the dividend yield, as you can see here, I got to change this back a little bit. Even though the dividend yield today right now is around 2.16, because it went up 1,000 points yesterday, and now it's down a little bit today. So it's two and change. I'm going to be making that with rare change. Okay, it's going to go up a little bit each year. Keep in mind, some companies do cut their dividend, but I have 500 big qualified companies that they're the biggest for a reason. Now, some will be failing. I mean, when you're in the S&P 500 index fund, you're going to have some Enron. You're also going to have some Amazon. You're going to have some Apple. You're going to have some General Electric, which hasn't done well lately. You're going to have some J&J. You're going to have some Microsoft. You're going to have a whole bunch of other companies you're not even researching, and you don't care. You want a broad-based index that's going to give you this income stream. So the one thing we're going to focus on is, again, Jim Collins in his book, let's see if I can get that for you guys there, Simple Path to Wealth. He has a chapter in there that says the market always goes up. And there's a funny story. I had visited Jim at his place down in a little place called Oostburg, and that's more backwoods than even where I live a little bit. But what he did is I made the mistake of changing the words around when I'm talking to Jim. I said, I love that chapter of your book, because it was so right. The market never goes down. He goes, no, Keith, that's not what I said. The market does go down, but the market always goes up. It doesn't always go down. It does come down periodically. We know that because we can look at this chart right here. And if I still have it, if I have it up, can I show that to you guys here? So there are going to be down times in the market, and this, like right here, this is a long time where the market traded sideways. 2008, the market came down. That's just what it is. There's no way around it. We can't go out there and say, let me see what we got here. Excuse me. Oh, and actually, Andy's asking if I hold an international fund. I'm gonna give you an answer to that in a second. These down times really seem like the end of the world, but if this was not a logarithmic scale, even the Great Depression would be hard to see. And the 1987 stock market crash is such a small blip that if a fly took a walk across the paper and took a stop, and you know what I mean, it would be hard to discern between the fly speck and the 1987 stock market crash, which was 22.6% down in one day. the answer to this whole thing is that the money that is being made in the market is being made now, because right now, if you buy it, if the market goes up, even if it goes back to its original highs and just breaks even, people have bought at the high, you're still going to have made some money. Now, Andy's asking a question that I think is very salient, because what I do is, let's see if I got here, P ratios, and we'll talk about this in a second too. I'll tell you what I hold when it comes to my investments in index funds. Well, let me go back a step even. When I buy individual stocks, I tend to buy domestic. Okay, so I'm going to buy companies that are going to be on the American stock exchanges. But I do some of that. I try to get out of it, but it's just too much in me that I like to read this kind of stuff and study it, and I want to make some choices. And we're going to talk about something, a PEG ratio, in a little bit too, which is going to be kind of interesting. But when it comes to my index funds, I do like to. The other thing that when we talk about international funds, and I'm looking at comments here as we go, when I have index funds, I usually go about 70% S&P 500 index fund, and people then ask me, why not the total market? Because I started with the S&P 500 and I don't want to switch it all over and pay a tax. It's just what I did. And 30% goes to international index fund over at Vanguard. So I have a 70-30 split. Every year and a half, I go in and I kind of look at it and see if one's out of place or over the other, and then I'll kind of rebalance that a little bit. So I do have the international exposure. Matt brings up a comment about tax loss harvesting with the market being down now. Moving money to Roth, by the way, Matt, I do like the idea. Moving money, converting a traditional to a Roth does make more sense now, because of course there's less to move for taxable purposes to get the whole account over, and of course then it's going to grow tax-free after that. As for tax loss harvesting, in the description of this, there should be a whole bunch of blog posts that I have in there. I have one where that is called "How Tax Loss Harvesting is Ruining Your Portfolio." I think people that want a tax loss harvest should read that, and read it very carefully, because tax loss harvesting is okay if you have something to write it off against. But remember, you're limited to $3,000 of deduction per year in the United States against other income. Otherwise, it gets carried forward. The rules of the state you live in, whether it be an equitable property state or a marital property state, will determine what the value is should one of you die. If it's a joint account, or if you're married. If you're single, it's lost. It doesn't go to your heirs. And there could be a step up or a step down in basis. So there are certainly issues with that. I wouldn't mind tax loss harvesting, but I'm not a big fan. You'll notice I do not promote any of the companies that do the tax loss harvesting out there. I think was it Betterment? I forget, or Wealthfront. I forget the name of some of these companies, but they've been in contact with me, and of course there's good commissions on that kind of stuff. I won't promote it. I like getting a commission, but I don't. Everything that offers me a commission doesn't mean I'm going to actually do it. I don't like the tax loss harvesting products, because there's really too many issues, and of course it's made the news now that it's not always as good as it should be. Tax loss harvesting has a place, but you need to be cautious. It's not the answer to everything. I always want people to be careful with that. So let's go and come back to my little thing here. Markets always buy shares for future profits. I want to get into some of this here, because right now it is so easy for people to look at this stuff. They start looking at charts and they'll say, well, I'm going to buy now. Well, first of all, if you have some money that you took out, if you wanted to get out of the market, you should have got out of the market when it was high. Okay, nobody wants to sell when it's going up. That's when you want to sell. I did sell some of my stuff in January of last year, so about a year ago. I did some selling over the summer when it kept on going up. I just said enough is enough. In fact, I sold some it was at February 1st. So February 1st of 2018. I had sold some of my investments home. And it wasn't a market timing thing. It was like, interest rates are going up. I can get some money from there. When I don't understand something, I just take a step back. And I'm willing to sell something, or at least consider sell something, if it's doing really, really well, the whole market. when it comes to an investment in an individual stock, I don't like to sell unless I think the company's not going to do as well anymore. The facts and circumstances have changed, or maybe I misinterpreted it. It's the Warren Buffett buying H&R Block and finding out the tax industry might have a long history, but might not be exactly what you want to be investing in. H&R Block, by the way, wants to buy me out all the time, and I keep on saying no. I don't know what you guys think. You guys can give me tell me if I should be a franchisee. I'm joking with that, by the way, because I would never sell. And he says, thanks, Keith, for answering my international question. I was spending a lot of time trying to figure out the right U.S. international allocation. Your allocation is close to Vanguard's recommendation. Yeah, and again, these I want to make sure I'm not making recommendations. The old adage where they say prescription before diagnosis is malpractice. And I may know some of you people. I may see you on my blog. I may see you on Facebook and social media, but I haven't reviewed your. Something locked up. Can you guys still hear me? Somebody give me a thumbs up. Tell me that something's still working. Can you guys still hear me in this? Well, it's still recording, so I think I'm going to keep on going. If hopefully there is no problem with that. Let's go. Are you guys still seeing this here? I'm getting I lost feed. Okay, somebody tell me if they can still hear yet. Otherwise, I'm just going to keep on going, and it's recorded, so we can go later. It's all working. Okay, I can hear. Okay, good. So how do you invest in the market, and how do you get all these emotions out? Because Warren Buffett and Peter Lynch aren't smarter than you and I are. They control their emotions. When I have my best experience in the stock market and I see my numbers going up and I'm making a profit and I'm doing very well and I'm building my net worth, it's not because I'm smarter than you are. It's because I found a way to control my emotions. And my emotions are the part that will kill me. When the market is down 1,000 points in a day or two, when the market's up 1,000 points. Think of it this way. On Christmas Eve, boy, it's the worst Christmas Eve ever in history, and it was only a half a day. Thank God they closed early, right? How can you possibly invest in that environment? If you're looking at prices, they're in free fall. Look at the chart. If you're a chartist, you're going, it's over the cliff. Why would you try to catch a falling knife? A Wall Street adage. Well, okay, then the market goes up 1,000 points the next day. A little easier to invest now, right? The market's up 5% and it's easier to invest. Really? So Walmart raises the prices of socks and things like that the next day, and you're going to buy more of it because the price went up? Probably not. It doesn't make sense. So what do you focus on? Well, you can look at historical numbers here, like the PE ratio. Okay, Stephen, I'll touch on some of that for you. And actually, I wrote a blog post on that too, but I didn't put it in the listing. I don't think I might have, but I'm going to go into some of that when you're getting closer to retirement, how much you should keep in cash. The PE ratio is still not necessarily all that low. That does not mean that I feel the market's going to go down. I'm just saying that the market's been higher and lower versus earnings compared to the price. It's certainly not as overpriced. As you can see here, whenever it gets around 25, it gets to be bad, with the exception of 2008 when the oil companies lost money. It made the whole S&P lose money. So it was just, it spiked the numbers. So that wasn't really, it was more along this line. 2001 with the dot-com bubble, of course, was an issue, and that was the only time it went higher for any period of time, ended kind of badly. But an 18, 19 P ratio is neither higher nor low. And if I have good companies or I want to buy a future income stream, I'm certainly not going to wait for these moments because they may never come, or they may be far and long between. This is what I'm looking at. I'm always going to be looking at this here. And if I refresh this, so we're at about 2.15%. So I'm going to get a 2% dividend yield, and that is what I want. I want that future income stream for the next rest of my life. So the only time I'm going to sell, and I almost never sell, the only reason why I sold a year ago is because the market was going parabolic for a while on one hand. And it really, really made me nervous with it. So I felt taking some money off the table would allow me to buy other investments that were not necessarily in the stock market. So they were in a money market account. I could either expand my business, buy another firm. I could invest in a local company if I wanted to, and it would give me the resources to do it. So it was not a timing call. It was taking some chips off the table because I had a profit, and it would allow me to allocate to other businesses because I'm a big advocate of investing in businesses. I'm not a big fan of bonds and things like that, though I do have a little bit of that as well. But when I say a little bit, I mean a very little bit. So, okay, and Stephen, I will get to your stuff though. I want to kind of go through what I'm doing here, and then I will get to that. Let's see what I. So, okay, I want these future earnings. Actually, what I should do here is put this back up here for you guys. So when I have, so these price earnings ratios here, this is what I was talking about. And then we're talking about the dividend yield. Dividends, actually, what here's what I really look at. This chart right here. These are the dividends that are paid out by the S&P 500 as a whole. So if you're in an index fund, this is what you're going to get. So they do sometimes come down. This is not the dividend yield. This is the actual dividend itself. So it has been trending higher. Now, it does have some pullbacks along the way. In 2008, when things got a little ugly, some dividends did go down. But then again, they catch up afterwards. So will dividends come down from here? Yes, but keep in mind, they're not going to go to zero. If they do, there's a really big problem, and the stock market won't be the biggest problem in my life, and it won't be yours either. So I'm buying this income stream. I'm buying it off the top already. So dividends are up. And the world's not coming to an end. Okay. And if it does, well, then we're gone. And you can't sue me because we're dead. We're all gone. So the idea is to buy this income stream, because keep in mind, these dividends keep on reinvesting at whatever price the market's at. So, if you bought down here back in the 80s or in the 70s or in the 90s, you watched your dividends double or triple. Those dividends, though, bought more shares, which means they earn dividends. It's like a pay increase every quarter. So even though you see some of these down points here, it doesn't necessarily mean that your income went down that much. If you reinvested the dividends, you kept on buying more shares at lower prices, which means you had a bigger ownership of these companies, which means that you have a bigger rate of return, a bigger dividend check each and every quarter. And as time goes on, the market goes back up, then you make an extraordinary amount. It's why you make more money in a bear market than you do in the bull market. So I'm gonna, and by the way, guys, I do have time. I'll be getting the questions. So I'm gonna actually go to the comments here and the questions, because there's some pretty good ones in here. So I'm gonna start with Steven. He said, "Hey Keith, I'm a year out from retirement, and I'm considering changing my focus from a tax-free retirement account similar to Roth to dividends rather than capital appreciation for all contributions going forward. 12K a year between. I'm considering investing in 3 different 12K a year for my wife, and I could generate about 5.5% a year tax-free income." There is nothing wrong with that. I wrote a blog post about this recently, and let's see if I can pull this down and then pull it back up for you guys. I talk about these allocations because I argue, and I think very strongly, and I think I'm correct with this, you shouldn't be 100% invested in the market all the time. And the reason for that, let's see if I can get to my archive here. There are times, oh, here we go. A couple weeks ago, is staying fully invested in the market the right move? So this is staying, and the answer to that is it depends. If you don't have very much money, and that's what I do. I start with people making a little bit of money, having a little bit more money. Then I talk about business owners, side gigs, and then when you get to retirement. So Stephen, the thing you have to look at is, if you are going to stay in the stock market, let's say in the index funds, you certainly want to have about 2 years, maybe a bit more, in a money market account for living expenses. That's what you're going to pull from. And if you're a year away, you don't want to be like that person putting their money into the stock market to buy a house 6 months later. That's their down payment. There's no guarantee in 6 months that the market's going to be up. It can be down over a 6-month period. I'm talking long periods of time. I'm talking about income streams. That's the important part here, folks. I keep some in cash. Sometimes it depends on the facts and circumstances of my personal life. I'm not in retirement. I'm not close to retirement. I don't think I'm the kind of person that ever will retire. But moving into something that's going to be, let's say, tax-free, you want to go in and get something that's going to have some kind of dividend yield or interest rate, maybe some municipals in that. I have no problem with that. I don't like all the eggs in one basket, though. I wouldn't mind having something if you want to have a bond fund or something, or some kind of a vehicle that's going to throw off a yield. Here's the reason why I still think index funds make a lot of sense. If, like this, I want to be serious about this, because I sometimes like to be humorous in my own little way, but I want to be completely serious about this. If you are approaching retirement or in retirement, you don't have to have this all or none attitude. You can't say, well, I'm in retirement, I can't take any stock market risk. Okay, so you want $12,000 per year, you need $1,000 per month, you need to put X amount of dollars into the market. You're going to have a couple of years of expenses. So you're going to have maybe $24,000, $30,000 in a money market account. That money market account is going to earn interest at 2% or so. The rest of your index fund is also going to have a dividend yield. If the market is down and you're depleting your money market account, you just tell Vanguard or Fidelity, the mutual fund company, to not reinvest your dividends, just send them over here into your index fund, or excuse me, into your money market account. So it's going to take longer than 2 years or 3 years. It'll take 5, 6 years to use up all that money, maybe longer. In which case the market's going to have recovered and it's going to be back to a new high. And anytime the market goes back, then you refill that money market account so that you always have that 2-year, 2.5, 3-year cushion. Now, that does not mean that you can't have a bond fund. It doesn't mean you can't have some bonds in that. It doesn't mean you might not want to have some municipals. The issue having Roth IRAs, things like that, that is tax-free, of course. You can move around inside of that pretty easily. You could buy, I don't know if there's index funds for this, that would be based upon, I think they're called aristocrats of the S&P 500. They're the dividend growing stocks, if you will. And so Facebook wouldn't be in there because it has no dividend, whereas you would see something like Altria, which has a dividend yield, keep on growing. And you're not interested so much in the actual price, because these prices don't generally go up very good in these stocks, because they keep on taking all the profits and giving it to the owners, which I got to tell you, that doesn't hurt my feelings. I kind of like that. So I hope I answered your question, Stephen. If you want me to go deeper into that or want me to clarify, I certainly can. Matt asks, along the lines of the Roth conversion, it's also fantastic because most likely the tax rates will go up in the future. And I agree. Sometimes people get really, really upset with me when I say that I don't like the last tax cuts, the last tax bill. The problem with that is that it doesn't mean that I don't like lower taxes. It's not a political statement. It's just that I think that the tax bill was made too quickly and there's too many errors in it and there's no attempt to fix it. I don't mind lower taxes, just like everybody else. So I don't care which side of the aisle you're on. Everybody takes their tax cut. The thing is, we want to have appropriate taxes. It needs to be fair, and if it's going to, and that's hard to do because you're taking people's money, is what you're doing, and giving them basically, well, we'll let you live in the country, so to speak. We'll have national defense. We'll have social programs like Social Security and Medicare, and whether you like those or not, you're in this all. We're all in this together, so to speak. I think the opportunity funds are one of the greatest deals in the world. I love that idea. And I hope it sticks around. I think the sell tax limitation was also a poor idea. I think there's some, and I think it was political inside of this. So I think it was a tremendously poor decision on some of these things. But I do like the tax cuts, and I do think that when you have a good economy and you're running $1 trillion deficit, you're not going to grow your way out of that. I just don't. The mathematics of this does not work. So will taxes go up? Well, either they're going up or you're not getting Social Security or Medicare, or you're going to have to start cutting the military. Those are the only three big items big enough to make that big of a dent in the budget. And if you cut those things, the government's spending that money. If you give it back to the people, then people might spend 80% of it and save 20% or something like that, in which case it's going to be a negative to the economy. So realistically, tax rates probably go up in the future, and that is a risk. And especially when you have a lot of money, as time goes on, you build this great big nest egg and you're happy as can be. Now you got a lot of money. And when you start pulling money out at higher rates, the tax rates can be higher. So I agree that with Matt, that converting this over. And the other thing that Matt didn't bring up that somebody may have, though, is that with the Roth IRA, there is no RMD, which is that required minimum distribution when you hit 70 and a half. I understand why it's there, but understand I hate the RMD as an accountant, and here's why. When you come into me and you say, let's do some tax planning, the more moving parts I have that I can control, the better I can save you money. But the RMD, I have no choice. You hit 70 and a half. That is the number. That is the floor. I have no control over it. And when I lose control, I lose the one huge advantage to help you save taxes. My goal is to help you keep as many dollars of yours as possible. And if you want to pay more, if you feel altruistic, I bet if you invested in your community, in the nonprofits and in the organizations and in the things that get done in your community versus having the government do it, I bet it's going to do a far better job and you'll be much more involved in it. And again, that's my opinion, maybe a little bit political there, but I think it's worth doing, worth considering. So that is another thing that when Matt brought up the tax brackets. Stephen, dumb idea, or concentrate on building value of these accounts by leaving all dollars in the account. That's taking tax-free earnings out on a regular basis. And the answer is yes. There's no worries, Keith, if you don't have time to answer, don't want to hijack your agenda. No, it's not hijacking the agenda. This is important stuff. This is for you guys. I'm telling you, this is kind of like a consulting session. People pay me a lot of money for. And we're going to have this back and forth and share ideas. And what I'm bringing to the table is my almost incredible hours of studying and research, my background in accounting and taxes. So I think what you're asking is that maybe leave all the money invested. If you're getting, and make sure I'm getting this straight here, I think you're looking being a year away from retirement. The answer to this is, it depends on your facts and circumstances, and I know that people hate it because when I say those words, but in the tax code where you get explanations, that's what it always says: the facts and circumstances determine. If you come up to me and say, "Well, Keith, I need $2,000 a month to live, and that's it. That's all I need, and I got $1 million, maybe a bit more than that in the stock market." Hey, the dividend yield's about $24,000 a year. I'm going to say, okay, if you want to invest everything back into it, and then if the market goes down, who cares? I mean, you pretty much got your expenses covered. I'm good with that. But when you get close to retirement or enter retirement, I really do think it would be a good idea. I think it would be a good idea to have at least a little bit in money markets. And I know that they don't pay very much and that kind of thing. But I got to tell you, I'm 54 years old and I have no intentions of retiring. But for some reason over the years, I felt more and more comfortable having a little more money in my working capital account. Prior to the money markets paying a little bit more than like they are now, in that 2% and change range, I was using things like Capital One 360, which I still do, Discover Savings as well as I still do now for my business. And it kept money that I had liquid there. I really think that there's no crime of having a little extra cash sitting around. Now, here's where I would argue against it. If you're young and starting out, or the values are extraordinarily low, if you're under 100,000 in liquid net worth, you need to ride out the bumps, the ups and the downs. You don't have the luxury of not maximizing your efficiency. Okay, so I'm not maximizing my return anymore. I don't care. I want this smooth ride. I don't even want the irritation of having to sell something over there. I got to sell that investment over there to make that investment over there. Oh, one of my clients has something, so I'm going to invest in their company, and I can't do it without selling that, and the market's down. That's not going to make me happy because I can't do this investment over there then. And that sometimes happens. I can't invest in something, and that irritates me a lot. If the market's down, I won't be selling it. I think that it's okay to have some money in cash, and if you have a small amount, your risk is being out of the market. You need for it to grow. It's going to grow faster than any place else in the market over long periods of time, especially looking out 5, 10, 15, 20 years. If you have a low net worth, it's probably because you're also young and you need to be in. That is where you need to be. Once you get older, then we start looking at some of these things here again, where we start looking at my blog posts and we start asking questions. If you have a side gig, you might always be bringing in a little bit of money. I make enough money in a side gig to cover all my expenses, so it doesn't matter if I had anything in cash. But I do it because I want money for other types of investments. So I talk about people that have $1 million or more, $100,000 to $1 million, under $100,000. You might want to check this blog post out. That is linked, by the way. So if you're interested in that, you can do so. Drew asks, hey Keith, what are your thoughts on REITs, and do you have a place for them in your portfolio? I don't own any. However, I own something kind of similar. I'll tell you what I did. You guys will love this. Because if you look at my thing, these are all the things over at let me put this up here so you can see it. This is CNBC again. If you look at this thing down the side here, these are all the stock quotes that I looked at recently. A lot of times I'm just looking because I'm nosy. I want to know what some company is. I read a news report on it. I don't own any REITs, but I happen to own a few shares in Unity Group, which was spin-off from, I think, Windward, and it pays a really big dividend. The dividend yield is rather high, and there's a risk it's going to be cut. It's one of my flyers, so I don't have much in it. I maybe have $30,000 in this thing. What I did is I sold some puts again on this, and they expired actually last Friday, so I kept all the money. I had some January 2019 puts, which I cashed in a while back, which turned out very good. But this is the reason why is you get these K1s, and I hate doing them on tax returns, so I don't want them on mine. As for REITs, I don't hold any REITs in my portfolio. Would I own some? Well, there are some tax advantages to the REITs, I think, now. Would I own them? Let's put it this way. I would not own them for me because otherwise I'd already own them. I think that because of the tax code, they might be a little high priced now. I'm not a big fan of chasing the REITs. And that's kind of smacks of market timing. If you had 5 or 10% of your portfolio into REITs, especially like an index fund, maybe that would handle all the different REITs, I think that might be a reasonable way to go. We certainly don't want to buy real estate and buy a lot of it and have it all invested in Detroit in 2007. And of course you didn't know that in advance. Okay. We didn't know in advance what was going to happen. Lehman was that outlier. It was a normal recession coming up like we have right now. It's not the end of the world. It's just, whatever's going to happen. Getting a little pullback, maybe a little slowdown in the economy, maybe unemployment ticks up a little bit, but it's going to be there. Life goes on and we'll get through it, and the government will all get bent out of shape. Inexperienced investors will sell at the low, which is not really good, but I use it. This building is being used for my business, my farm. I live there. I grow some things. I have a land contract which pays me 10%, which is pretty much done now. But the real estate's one of them love-hate things for me. Just my opinion, and that is purely opinion. That is not a recommendation for or against. Stephen said thank you, and you're welcome. And let's see what we got here. I will definitely read the blog. Thanks for sharing. Yeah, go through some of those things. If you have more questions, that's where the Facebook business page for the Wealthy Accountant, as well as there's a group page, which is a private group. And the reason why we have the private group is because people didn't always want to answer questions or talk about things in the business page, because then everybody can see it, including your friends and family. In the private group, people in the group can see it, but only people in the group. So if you want to talk about something financial in your life, you don't necessarily have to have your friends and the neighbors and Uncle Louie and things like that commenting on, holy cow, Joe is loaded. Well, yeah, okay. I understand not wanting to talk about it. So that's good. Reading the blog, Stephen, I think that's a great idea. I mean, and it's self-serving as well, but I really do put some thought in this stuff. I think I have changed my style a little bit lately in the last several months. I only publish once a week now, but I try to be a little more all-inclusive, and I try to tackle subjects a little more in depth, and I try to be, instead of just providing opinion, this is how you live your life, which is helpful to a lot of people. I'm trying to focus a little more on the tax end of it because I want to narrow my niche, but understand that I'm really a guy that talks about money. How much money can you have? Can you build a net worth so you have a good life? Drew said, thanks for the in-depth answer. And then we also have here, and Carlene, I didn't miss you. I'm just kind of looking. So I want to read ETF pays me over 4.8% dividend year. It's about 5% of my portfolio. I consider it part of my diversification strategy. Stephen had commented on that. I think that's a very reasonable way to approach it. I'm going to be curious how this is all going to flow through with some of these tax implications here. And Drew is an accountant, so he's going to be looking at the same thing. I have looked at some of the programs and how some of this is working, but once you get into the trenches, sometimes we discover as accountants that things are sometimes a little different than we anticipated. So as I commented over this last year on the tax law changes, unfortunately, I know that I've changed my tune a little bit because some of it, the interpretations have changed. And we're all making this stuff up as we go because we all know that taxes are reality, right? It's all made up numbers. We make up these rules and then we try to follow them and try to figure them out. Carlene said, hi, Keith, I'm very unhappy with my Ed Jones broker because of high fees. Yeah, I hear you on that. And he keeps buying things I haven't approved with dividends. Okay. If he's buying things without your approval, he needs to be fired instantly. And let me talk about this. I'm going to talk about something you can do to save yourself some taxes here. So when you move, I just want to move to Fidelity. It's just 401k and Roth. Okay, that's not a problem. Is there any reason to wait for the market to turn around before I opt out of this relationship? I have spoken to him and told him not to buy anything different, and he's lost my trust. Let me be totally honest with you, Carlene, damn straight. Their job is to take your orders with that, to provide you advice, to help you make good decisions financially. Their job is not to go out there and unilaterally make changes to your account. They do it for one reason and one reason only, a commission. And if they're doing something for commission only, they're not working for you, they're working for themselves. And I like making money too, don't get me wrong. When I do taxes and I do my stuff, I do this, I hope people come to my blog, I hope I make lots of money. But if my goal when I'm doing this isn't to make your life better, then the money is not worth it, because that's just prostituting myself, and that's what he's doing. He's one of the bad ones. Ed Jones usually keeps a tight rein in their brokers so they don't do that stuff. I'm going to say this a little bit cautiously, but I'd probably complain to the company and I would move it. And by the way, since it is retirement accounts, there's no reason to wait. The stuff that's in there will transfer. You can do a direct transfer from Ed Jones to Fidelity. Fidelity should help you do this, by the way, and it should transfer very quickly. The only thing that happens is while it's in transit, which might be a little bit of lag time in between, you won't be able to buy or sell in that time frame. The stuff that's in there, but that usually isn't very long, maybe a day or so at most. If anybody's listening to this, either live or in the future listening to this, if you have it in a non-qualified account, a non-retirement account, selling in one account to move it to another account could be expensive tax-wise. There's something called an ACAT transfer. They can transfer these things in kind from Ed Jones or any brokerage firm to Fidelity or Vanguard or E-Trade or TD1 or any of these types of brokerage firms. And there is no taxable implications then, because you're just transferring the assets over. It's just, you're not selling them, you're just moving them from one account to another. Is there any reason to wait? No. I don't mind that they have dividends. I don't mind that he's doing that. That's not even that. He might not even be doing anything wrong from that viewpoint, but he's doing something extraordinarily wrong when he's trading in your account without your permission. Man, that is wrong. Because if it goes down and it doesn't work, what's he going to do? Shrug his shoulders? Well, it's your account. You should have known better. No. I would not wait. If you have a bad broker, just move it to Fidelity. Talk to Fidelity. I think when you go online, you can set it up and you can actually call them and they'll walk you through this. It usually goes pretty easy, pretty quickly. So transfers are pretty good. If you have anything else on that, Carlene, just let me know. And I can kind of point you in a direction with that, or I can even ask more here. Jeff, the next question I have, Jeff Rogers, my CPA says we're not going to know about some of the new tax laws like the 20% deduction until it is tested with the IRS. He's very conservative. He says there's a lot of gray areas since it's all new. I'm paraphrasing him. Your thoughts? Well, he's right and wrong. Okay, so your CPA is right and wrong. The answer is true. It hasn't been tested, and there is no doubt some of this will be tested in tax court. There is some ambiguity in the tax code that's going to be a problem. QBI, the 199A, is going to be a big issue. That's why I didn't get into the details with Reits, because I want to see how it works through the return. I want to look at some of these things. My original interpretation of some of that code is not what the code interpretation I have today. I'm building policies. I have the previous Facebook Live event is about 2 hours, hour 45 minutes, where I talk about year-end tax planning. I go into that in detail. The thing is, you have to make a decision anyway. Is it going? It's not licensed to stand like a deer in the headlights. Is it going to be tested? Sure, it is. Will it be you? Let's hope not. I hope it's none of my clients either. I'm taking a position where we just don't have clear answers all the time, so we build a policy. The biggest issue I see around the 20% deduction, which you're talking 199A here, I'm assuming, is, especially if you have rental properties, is what is the definition of a trader business? The tax code doesn't tell us. You have to go to the tax court. And I've come up with a policy that says that if you sell an asset, like a rental property, and it goes on Form 4797. When you sell it, it's a trader business. If it goes to Schedule D, it's an investment, and therefore it is not. If you're a CPA's job is not to be conservative or aggressive. In my opinion, a CPA's job, and by the way, I'm an enrolled agent, so I'm a CPA is an accounting professional. I'm an enrolled agent. I'm a tax professional. Some accountants focus on tax, some do not. I'm going to pull this down here for you guys. So when we talk about this, so what is a CPA's job? Any tax professional's job is to present the facts and the opportunities you can use on your tax return. I do not fault a client for not taking all my advice. In fact, you shouldn't. My job is to show you what the options are, and then you have to make the call. I can help you make most of those calls. Some of them are no-brainers. It's like, there's 87 different choices here. This is the one you want. I'm going to go right to what you want to do. But being conservative, let's make sure we have the different, clarify the difference between conservative and aggressive. If you mean aggressive by they're taking all their deductions as they're allowed, that is not aggressive. That's called smart. Okay, and I'm saying that facetiously, but I get this all the time. Conservative is not overpaying your taxes. Okay, because that's a lot of times what it is. We can't do that because I'm afraid to do it. You know what it is? I think it's Form 8275. I might have that wrong, but it's the disclosure form. On a tax return, if I'm taking a position and it's really not clear in the tax code, I'm going to disclose it. This is what I'm going to do. Now, when it comes to the trader business issue for rental properties, and even really some small sold props as well, do you have a hobby or do you have a trader business? I will probably not disclose all that information because it's all an issue this year. The answer is your accountant should be making, they don't have to necessarily make the decisions. Your accountant needs to be communicating with you. And too many accountants, too many tax professionals, I think Drew will agree with me on this, is that they spend way too much time just data processing. talking to your client, working with your client makes a lot of difference. It's I mean, the money is not made for you with your tax professional during tax season. It's data processing. We're plugging the numbers. We're busy. We're not sleeping. We need to move on to the next client. Where we make money is outside of tax season. You're listening to this, talking to your accountant now, talking to your accountant during the summer is where all the difference takes place. And Drew brought up, also said Reits dividends qualified for QBI, I should say. Yes, they do. The reason why I'm stepping around it is I'm going to be curious how they're going to calculate how much comes through, because Reits generally, if I'm not mistaken, I think Reits don't pay taxes as long as they pay at least 95% of their profits out to the owners, and you get a K1 usually in these things. So I'm wondering, I don't have a index fund REIT, and I'm not sure if you get K1s from them since I never had them. I'm trying to think of I'm not real sure how that's going to work in the return. I guess I got to see it. Mostly I just don't have a lot of experience with that. It just doesn't happen a lot. So, and Drew is agreeing with me here, and I'm assuming he's agreeing with the thing that we should communicate with our clients. Where, by the way, and going back to you, Jeff, as well too. Most accountants, I believe, most tax professionals don't want to communicate with their client because they think that they don't want to get paid. Okay, and Drew has some additional adding, don't go on a K1 but on the traditional 1099. Okay, so Drew's adding some information also on the side for these REITs. So REITs are not my strong point. It's something I never played with a whole lot myself. So but let me go back to your thing, Jeff, about what the accountant is afraid of. The accountant is oftentimes afraid to serve the client where they really can do some value because they're afraid that they don't want to, that they shouldn't be paid. It's either because they don't have the confidence either to ask for a paycheck for doing the really valuable work, or sometimes clients have the attitude, well, you did my return, now you got to do everything else for free. To which I tell clients, if they bring that subject up, I say, well, when you go in for your annual exam at the doctor, make sure they give you that coronary bypass for free too. It's not going to happen. The real important stuff is going to cost money. And if you tell your accountant, and I would make it clear, because most accountants aren't, it's not that they're bad, it's that they're afraid to spend their time at it. And if they realize they're going to get a few dollars into their pocket for doing this, have them do that research, have them do that background, have them look at your return and come up with some ideas. Here's the other thing, Jeff. If your accountant, your tax professional doesn't communicate with you, how in the hell are they going to know about your life? And what I mean by that is, I've had conversations with clients, and you understand, I'm a talker. I love talking with people. My clients come in, and I'm talking with them all the time. I'm communicating with them, and all of a sudden, 5 years go by, and one day they sit down. It's the middle of summer. Come on in, let's have a chat, have a cup of coffee. Let's enjoy our day. And we start communicating, and we start talking, and we're not talking even business. We're not even talking tax planning. We're just shooting the bull. No offense to the poor bull. Steak for dinner, right? But all of a sudden the client will say something that's like, stop. And I'm like, what did you just say? And then they said something, because we're communicating, that allowed me to open a whole new seam of saving my client money. And this has happened once or twice over my career, where it's like, man, I missed it. And I didn't know how to ask the right question. I didn't know it was there. So always go out there, and he's on retainer, so he takes care of a lot. He doesn't want me to get audited. It's okay. Well, by the way, on January 9th, I have just opened up a Facebook Live event. I'm going to show you how to audit-proof your tax return. All tax professionals and home gamers, people doing your own tax return, you want to do that. I'm going to show you how. I literally have 1,000 people in the office, 1,000 clients, and I sometimes go 3-4 years without even one audit. The only audit I would get is a correspondence audit if they forgot a form. They forgot to tell me they had a brokerage account over at TD Waterhouse and they sold $4,000 or $5,000 or $10,000, $20,000 of stock. But as for getting audits, audits are almost never in my office. The audit work I do in my experience in audits is because I've worked with other firms bringing in audits so I can get experience with it, which is what I'm very concerned about. So if he's on retainer, that's fine. He's still getting paid. Technically, if you're on retainer, so if you give him a $10,000 retainer, it has to be put into a segregated account. He doesn't get access to that money until he earns it, which means part of it is the consulting. And if he's conservative, I should say he wants me to survive the audit blameless. You can do that. I'm going to be covering that in the next couple of weeks. And 2 weeks from now, when I have that audit proofing your tax return, I'm going to show you how you can do that. I force him to discuss things with me, and we have done this 2 to 3 times a year, which is good. But you shouldn't have to force him to do that. Your accountant ought to be interested in you. Yes, agree in all your comments on where we get value. Drew had put down as a comment. Value is created during consulting throughout the year, not necessarily during busy tax season. By that time, you're mostly working from a reactive service rather than proactive. And Drew's 100% correct. I'm in triage mode during tax season. I'm just trying to get through the mess. It's like a war zone. I'm tired. I get exhausted. I have long days. Mentally, I'm exhausted. It's like kids go to college. You go to college and you have, this is exam week. I got 10 weeks straight of exam week, and anything under 100% is not a passing grade. So I am certainly not going to have as much time for consulting. If you read my blog on the Working With page, you'll realize I turned off consulting now. Only regular clients will get consulting in January, and then even during tax season, unless it's absolutely a crisis situation, an emergency, it's turned off until June 1st. May is my recovery so that I remain somewhat sane and normal as a human being. And tax season has just got to be tax season. So I don't know if there's going to be any more questions. We kind of got off topic a little bit here at the end. The stock market, guys, this is the chart you want to be looking at. This is the one you want to keep firmly in your mind. The market will go up. This is not the end. Short-term money belongs in a money market account. I know it only pays 2 and change. That is fine. You're not interested in trying to make money in that. It's being saved for a down payment on a house. When you have long-term money, especially retirement money, if you're going to take retirement early or otherwise, this is the chart you need to look at. Even in this 1968 to 1982 frame, for 14 years, the market treaded water. Remember that if you were dollar cost averaging in, you actually bought somewhere in that middle part. So by the time the market started going up, you were making more money because you were dollar cost averaging, and your dividends every quarter was buying at some of those low points. And remember, the low points buy a lot more shares than you get at the high point. So, if you have a stock at $50 and you're putting in $100 every month, you're going to get 2 shares, and then if the stock doubles in price, you're only getting 1 new share every month. Carlene says, thanks for another live event. Great live event. Thanks for stopping by. If you guys don't have any other questions, I will wrap it up. We have about an hour and 20 minutes here, so I don't want to take time if there's nothing important going on. If you're interested in if you do your own return, or if you're an accountant, I'm going to go through what the processes I use to what I call audit proofing a tax return. And it's not always. I'm going to use some examples, not from live returns, but I have some fake returns that they give me I can work with for testing out the e-filing systems. I'm going to use those and show you how I change numbers around to get the right answer and classify things correctly. And then at the same time, when I run into a situation where the only way I can audit proof a return is to do something incorrectly, I'm going to do it correctly anyway, take the tax advantage. And then what I'm going to do is I'm going to make a disclosure. I'm going to show you guys how to do this, when to make the disclosure and how much, and go from there. Thanks for the live feed, and thanks to and change increases 5% or so to 50 years. Okay, I'm not sure. Dividends, so I guess reinvesting. Yeah, and reinvesting dividends, Jeff, they keep on going up. It's like a pay increase every quarter. The nice thing about owning an index fund is that you almost always get a pay increase every quarter, whereas with a money market, if interest rates go down, yes, they reinvest, but money markets are really a store of money. You're not trying to make anything. You just want to keep the corpus available, hopefully keeping up with inflation for a house purchase or for retirement, normal spending. You always want to have a little money. I think almost everybody should have a little bit of money. Even Dave Ramsey says if you have nothing and you're broke, the first thing to do is to get baby step 1 is $1,000 to an emergency fund, because everything else you do is almost worthless if you have a flat tire and you go right back into down the rabbit hole. So I think that's correct. We had a fair number of people come in here today. There's about 14 left. If there's any last questions, otherwise I'm going to sign out. You guys have a great day. It was I thought a good presentation. I covered the points I wanted to. I'm kind of growing. These lives are kind of growing on me, so I probably will continue doing them. and people like it, and it is kind of this communication. We can kind of communicate with the comments. So you guys have a great day, and have a happy new year. Be safe. Don't drink and drive. Just do smart things, and we'll see you next year. We'll have some more fun, and you guys have a great one, you and your family. Thanks.